All right, we're going to get started. My name is Caitlin Kardish. I'm a Senior Vice President at Gregory. We are a marketing and communications firm that works with ETF issuers and other financial service firms on their various marketing and communications needs. I'm excited to be moderating today's discussion on defined outcome ETFs. If you were in this morning's session on options-based ETFs, I think it set a really strong foundation for the conversation that we're going to have today. So I'll start with the introductions from our panelists. So maybe Matt, do you want to kick us off? Or I'm sorry, Andrew.
My name's Andy Guy. I am the head of trading at XFA. We are an agency-based execution firm that primarily sits on Chicago Board Options Exchange. And we transact in options, specifically in flex options for the purpose of this panel that underlie a lot of these defined benefit ETFs.
Thank you. Hans?
Hi, everyone. I'm Hans Williams. I'm head of ETF distribution at Calamos Investments. We are based in Chicago. We are an asset manager that's been around since the 70s that primarily built its identity in the convertible bonds arena. And then a few years ago, realized we wanted to get into the ETF business. And of course, the question is, well, how do you do that in a space that has more ETF products than actual publicly traded companies? So that's always the challenging part as a new ETF issuer is how do you do that? So I head up all of that as we continue to scale and grow our efforts in the space.
Matt Collins, head of ETFs and capital markets at PGIM. For those of you not familiar with PGIM, we are the $1.4 trillion asset manager for Prudential Financial, the large insurance company. We have a 150-year history of offering very defined solutions on the insurance side. I would say about 2 years ago, we brought that same concept to defined outcome ETF. So very excited to get into it today. Thank you.
Great, thank you all. So I'll just take a quick moment to set the stage. So as market conditions grow more unpredictable, investors are increasingly looking for tools that offer both participation and protection. So defined outcome ETFs have stepped squarely into that space, using options overlays to engineer caps, buffers, and floors that create more controlled risk-return profiles. So what started as a single product back in 2019 has grown into a category of more than 400 defined outcome ETFs, representing roughly $70 billion in assets. And the investor base continues to grow. Beyond advisors, we're now seeing defined benefit plans, institutional investors, family offices integrating these products into portfolios. So for today's conversation, we'll explore how options-based ETFs broadly, as well as more specifically defined and buffered outcome strategies, how they've evolved, how advisors and other investors are using them in practice today, and where this space is headed. We'll get into the design mechanisms of these products, new investor use cases, as well as the macro forces that are shaping the development and innovation in this space. So we'll start back in 2019, I guess. So maybe, Hans, starting with you, what was the initial problem or investor need that defined outcome ETFs were created to help solve?
Well, I think there are a few layers to this. We saw a decade where the Fed essentially put rates at zero, go buy stocks, right? So you go buy a beta ETF, and essentially for that 10-year period, with the exception of a few blips along the way, buying beta and just letting it ride worked really, really well. And if the market pulled back 3%, make sure you go buy more, right? And you get to 2019 and get into that decade, in conjunction with a demographic in this country that's obviously was and still is entering retirement. And so what happened was now that we've grown capital and we've seen capital appreciate a tremendous amount, we've seen the growth. How do we preserve it? And you also had a perfect storm of derivative-based ETFs that really began with the covered call ETF in the early part of that decade start to come to market. So you saw this confluence of this new market, meaning the derivative space, that you could now marry up with the transparent, low-cost, tax-efficient ETF wrapper after a decade of tremendous wealth growth. And so you saw in 2019, saw some of these buffered ETFs start to come to market. You know, anytime you look at a strategy and you see a beta tied to it, and maybe it's a, you know, I'm making this up, maybe it's a 0.75 beta to the S&P, you're hoping on a go-forward basis that if the market drops 10%, which you didn't see a lot of that for that decade, but if it does, in theory, I should only be down about 7.5, right? I should be protected pursuant to that beta. But when you can create a buffered strategy, a capital protect ETF, and then on a go-forward basis, know that you pretty much know to the dollar your capital risk. Like if it's a negative 5% buffer, or it's a 100% capital protect ETF where you have no capital risk, and you have upside to a cap rate, now on a go-forward basis, you pretty precisely know what your risk personality, your risk profile, and budget are going to look like. And so as that market in 2019 came about, and even to today, you're starting to see more of these types of products come out because capital preservation is just as important as appreciation. And so I think as time continues, as we see more of these derivative ETFs come to market, buffer-based, capital protection, and you're seeing the appetite grow, it makes a whole lot of sense for someone that's up whatever they've been up, you know, since 2009, 2010.
Matt, anything to add?
Yeah, I think for us, you know, if you look at our industry, right, if you spend 5 minutes at this conference, you'll hear the same buzzwords over and over. You hear about the S&P, you hear about long-term investing, 60-40. Those are all wonderful things for clients to understand how we, the asset manager, perform. It's for you to build portfolio construction, but ultimately there's something lost in that conversation, and it's the end client and their actual needs, right? So if you think about long-term investing, that certainly makes sense in a 401k, but life happens in a set of intervals, right? As an investor, whether you have a large nest egg or a small one, life happens in intervals, right? You're either saving for a house, you're saving for your daughter's wedding, you're saving for college, hopefully that's reversed, or, you know, your septic tank breaks. You have these liquidity events that happen in life. And if we went back to actually 1957 and we looked at the average drawdown every year in the S&P 500, the S&P draws down 5 to 10% 4 times per year. And if you have a liquidity event or you have some level of uncertainty on the horizon, whether it's 18 months or 2 years, you don't want to hear all this nonsense about long-term investing. You want to hear about something that fits that particular need, right? So as we view the defined outcome space or the buffer space, we view it as putting a window frame around your S&P 500 experience, right? And there's, you know, as you mentioned, there's 400 products, right? So your initial take is, well, that's a bit much, right? It must be very complex. There's a lot to sort through. 85% of the assets in the defined outcome space are just S&P 500 iterations. So what we want to do is increase the probability that clients stay invested in the equity market, but allow them to sort of see what they want to see out of their equity experience. And that's really, I think, why this industry is going to go from 65 billion to a multiple of that in the future, because it's solving for practical, real-world needs. Now, there's certainly portfolio construction, which we'll talk about later, and that's a whole different conversation for these products.
Great. Before we get to portfolio construction, Andrew, I'd love to bring it to you. How have improvements in market infrastructure, whether it pertains to liquidity or the creation redemption mechanism, how has that enabled greater product innovation and development?
Yeah, so going back a few years, way back in 2019 when these products first came to market, the liquidity provision pool was non-existent, right? So, you know, when we launched the first buffered product or defined outcome ETF, we're really only reaching out to 1 or 2 market makers to trade the flex options in these products, and that's not a very wide pool, even though the products were S&P based products, right? So as more product people came to the environment, you know, it became about different flavors, right? So like, we don't want to just have a 90% downside protection. We want, you know, these various different buffers. You know, we want different caps. We want, you know, we want income-based ETFs and all these different kinds of things. And what XFA and, you know, the market making community that kind of props up this flex option ecosystem did was, you know, wrapped the market making community into the fold and made it so that more products were able to be developed, right? Because, you know, it's all well and good that we can take some of the exposure away from the structured product business and build it into something that's marketable to the retail customer, but, you know, flex options are a very niche part of you know, options in general, which are kind of complicated and scary for a lot of investors, especially when you're building products off of them. But by rolling more of the market making community into the fold, now we're able to look forward at new and exciting things like levered products, income products, different flavors of buffered products, and you know, I'm sure that I'm short on a lot of ideas that they have, you know, in the upcoming years, because it's only been 6 years since we've been doing this, and really 6 years of history from, you know, putting flex options into ETF structures. But really, the sky's the limit. You know, it kind of comes down to the imagination of the product developers and the market making community's ability to deliver these options in a reasonable price for the, you know, to make up the baskets of potential outcomes, defined benefit or otherwise.
Got it. Thank you. Going back to portfolio construction and investor use cases, what trends are you seeing in how advisors and other investors are integrating these products into client portfolios?
I'm happy to start on that. So ultimately, there's really only two choices, maybe three if you add in gold, on risk off, right? So as you build a portfolio, you're left with a choice when you want to take money off the table out of equities because you're in an extremely stretched environment, today being a perfect example. You're really left with the option of buying a commodity, gold, or more, 90% more likely, fixed income. The problem is fixed income is triple the amount of vol that it's experienced historically over the last 3 years, right? So you're in this environment where the rates on the fixed income side are actually fairly attractive, right? 4% is a solid cash risk-free rate of return. The problem, if you have any duration whatsoever, 1 year plus, the volatility has completely wiped out your income. So from a portfolio construction perspective, what a lot of these defined outcome and buffer ETFs are attempting to do is give you the bond vol, but allow you to rise with the equity market, right? And we've gone back and looked at the 60-40. You'll say that the 60-40 portfolio has actually done really well, but it's because the equity has done 100, probably 200% of all of the heavy lifting to compensate for bonds problems. So what buffer ETFs allow you to do is stay in the S&P. A 12% buffer is 50% the standard deviation of the S&P 500 and 2/3 the return, right? So don't think of it as your compounding return equity exposure. That still has a tried and true place in a portfolio. But if you can knock your vol down by half and get 2/3 the return, that is an exponentially better proposition than what fixed income has provided over the last 3 years, but even historically. So while there's S&P and NASDAQ is in the name of these products, what we express to clients is buy the outcome. What is the outcome that product is trying to achieve? Because, you know, there's no free lunch. Every dollar you protect is a dollar you give up on the upside. So there are certainly products that allow you to keep pace with the S&P really, really well. But most of the demand is actually in this bond replacement category that fills sort of the void between equities and bonds in a 60-40.
Yeah, I can add to that. And what sticks out to me in my previous life before joining Calamos, I was on the sort of like the strategy, product development side of the equation. And my last firm, we spent a lot of time building a series of covered call ETFs. So I sort of view covered call ETFs, defined outcome ETFs in the same light. And you're right, Matt. It's sort of, it's like if you have a fixed income portfolio, you know, you'd love to upside maybe generate 8 to 10% for the year total return and really not sacrifice much downside. And in your mind, you go, to me, that's maybe, you know, an A- rated investment grade bond strategy. US, let's say US domiciled, US based. But then if you looked at a buffered ETF, let's say that's underlies the S&P 500, that can give you that upside with that precise level of downside, you could almost argue that could be a replacement for that fixed income solution within your fixed income sleeve. And I think back to 2022, where bonds were supposed to behave like bonds, and they did not, largely, right? Some did. But there were covered call ETFs that were down 3, 4, 5, 6% only total return in 2022. So what I saw coming out of that, in my previous life and also my current life at Calamos, was advisors starting to make that switch, starting to source capital for placement from securities, even short duration, that maybe were only 2-year duration within their fixed income sleeve, and start to instead use covered call ETFs tied to the S&P, tied to the NASDAQ, or in some cases defined outcome buffered strategies that delivered the upside that they were hoping for over the course of a year. If the septic tank breaks, for example.
Expensive.
My boiler is from 1987, so that really hits home with me. That's something I'm saving for in terms of a real-life liquidity event personally. These things happen. And over the course of the next year, for example, if I've got my 60-40 portfolio and I've got my bond allocation, I can't afford to have bonds down 10 to 15% within that sleeve, because I might have a liquidity issue over the next year. And if I can get 8 to 12 upside with some strategy that is not a bond strategy, that is a defined outcome buffered, for example, strategy, or some covered call strategy that might get me there, I see a lot of advisors over the last 3 years starting to switch to that, because 2022, in a sense, was a disappointing year for a lot of bond strategies.
If I could maybe just add one thing. The other aspect to this that we've heard from financial advisors and REAs is every active manager has a robust risk management process. The problem is you don't know how that approach will impact the next event. More often than not, they're building a portfolio for something that's happened historically, or they're predicting to happen, and then something else happens. And how you viewed risk for a certain active manager or a smart beta passive product ends up blowing up the rest of your portfolio because you depended on that to be your risk hedge. Bonds or otherwise, or on the equity side, defined outcome ETFs is the only investment where you can quite literally, on the efficient frontier, decide the amount of return and risk you want. You can self-toggle. You can self-build with these defined outcome ETFs rather than guessing at it or having due diligence calls with an active manager and trying to figure out how that blends with everything else in your portfolio.
So, Hans and Matt, it sounds like you're very much on the same page about the role of these products as a fixed income replacement or part of a fixed income sleeve. How would you say this fits into someone who's interested in integrating it into an alternative sleeve or more of their core equity holding?
Yeah, I mean, I think when it comes to alternatives, depending on who you are, you might say, I don't use any alternatives, or it might be a 3% slot. Maybe it's a 7. I never really have come across an advisory practice back when I was on the strategy side, sales side, that was really above 10. So yeah, I think if you have an alts bucket and you have, to Matt's point, very specific goals in terms of how much upside you're hoping to achieve with the solutions inside of it, and very specifically how much you want to risk, there might be a buffer ETF for that. But not all buffer ETFs are the same. Not all capital protect defined outcome ETFs are the same. So it really behooves you as the advisor to look underneath the hood, figure out, how is it structured, how often does it rebalance, and does that fit into my current mix of alternatives products, irrespective of wrapper. Maybe you have mutual funds and ETFs and other types of products inside of the alts wrapper. I think in your conventional, going to like the equity side, which equities arguably the most important, the biggest sleeve of any asset allocation, I think they very easily fit into that, because if you can marry up, say, a buffer ETF tied to the S&P to maybe your, for example, SPY, IVV, whatever beta ETF you're holding, and you can marry them together. If you own a beta ETF outright, there's unlimited downside, obviously, just like there's unlimited upside. But then if you pair that alongside a buffer strategy, an S&P buffer strategy, now you can cut out some of that downside when we do get a year like 2022, for example, where you have the S&P drops 18 or so %. So I think there are creative ways to use them throughout multiple sleeves, depending on how you specifically have constructed your asset allocation and what you hope to get out of it over the next market cycle.
Yeah, I would say it's what's holding the industry back a touch is clients not necessarily knowing how to classify it and where to put it. But I think to answer your question simply, it's certainly not the alternative bucket. You know, we prefer to keep those two things very different because a toll, you know, investment or a vineyard investment in the private market has absolutely nothing to do with an ETF that's giving you 12% downside on SPY, the most traded vehicle, you know, that the world has ever seen. So they're very different, but I think, you know, that question is hopefully one we need to solve to see this industry go further.
Absolutely. Thank you. Andrew, bringing it back to you, you mentioned obviously flex options underpin this ETF structure. Can you dive a little bit further into the reality of trading flex options today and kind of what you're seeing in that area?
Yeah, so flex options, I kind of mentioned that it was a little bit of a niche, right? Mm-hmm. So flex options specifically aren't traded electronically on the exchange, right? Like not everybody can go in and just, you know, get a market on a flex option, right? So that's what makes the liquidity pool so important, because brokers have to actually physically go out and call, you know, pick up a phone and call the market making community to get prices, compare the prices between the market making community, make sure that everybody's on the same page before they execute a trade, right? So it's not something that has lit liquidity like the normal options market, which makes it more difficult, which means that way back when, you know, we first started, S&P was about as, you know, exotic as you could get with these things. But as time has moved on, and I have, you know, a couple product specialists here, and they can maybe attest to this or maybe not, but, you know, the product issuing community has gotten more comfortable going further away from just S&P, right, into different indexes. There's bond products out there now. There's metals products. There's all kinds of different things because there's a market-making community who's willing to quote these options. The way that flex options are structured in that they're backed by the OCC, just like the listed options, means that when they're constructing these products and building them in, they have systemic protection, and they're not. You're not just, you know, when they're constructing these products, they're diversified, right? They have counterparties who are systemically protected by the infrastructure of the OCC, and you're not just facing off against a bank, and that helps them deliver the outcomes that they need. So the longer that these products are out there, the bigger the liquidity pool that's available, the further away from S&P we can get, which means that, you know, constructing these very different strategies and fitting them into your portfolio becomes more possible because there's more products that are out there for it to be done.
Absolutely. I'd like to also dive into some of the misconceptions about these products. Matt, you had mentioned just a few minutes ago that part of the issue with some advisor adoption is not understanding exactly how it fits into a portfolio. I think Boomer Candy was brought up earlier in terms of these are products for the retiree audience. There's no free lunch. I'm sure there's others that I'm missing, but what are some of the common misconceptions that you come across when you're talking to advisors, and how do you address them?
Yeah, what's in these products, I think, is one of the top questions. So I think there's a level of skepticism given the number of products that are out there on the complexity of what's happening behind the scenes. And that's actually fair, because if you look at a lot of the new products, they are using swaps or they're using options on less traded vehicles. And I think for us, you know, we manage about $40 billion on the annuity side. We call it FlexGuard on the Prudential side. 92% of our assets are just in S&P and NASDAQ. And our ETFs, we want to be able to tell clients that if you're moving from an illiquid vehicle like an annuity or a structured note, that we're investing in something that actually matches that liquidity, right? So we try to keep it very basic behind the scenes and only invest in the Qs if we're on the NASDAQ buffer or SPY on that buffer, because we want to be able to tell clients that the vehicle will stand up to the liquidity that they expect out of that product. And most of the early day adopters were actually coming from structured notes, where there's a significant amount of bank risk that exists, or they're coming from annuities in a 6-year lockup and a zero liquidity. So I think one thing we want to get across, in addition to the liquidity that these vehicles have behind the scenes, not just in the ETF itself, is also just the more inherently friendly structure that happens in the ETF. So if you think about a structured note, there's an end and there's a lump sum payment and there's a taxable event in these products. One thing that we need to get across, I think, more to financial advisors is with defined outcome ETFs, while it has a 1-year outcome period, might be 365 days, you're not locked into that. You can leave on day 2 or you can hold it for 10 years and there's no taxable event, right? Thanks to liquidity providers like XFA and Wolverine out there in the market, we're rebalancing everything behind the scenes in kind and starting a new outcome. As an investor, you have to do nothing. You can continue to hold that product. So the tax consequences of not having a lump sum distribution like you would in a structured note and annuity is actually a huge benefit as well.
Yeah, and I can add to that. So in my experience, immediately I start thinking about launching a new, say, capital protect, covered call, defined outcome buffer ETF, and maybe flex options are used, for example, especially with covered call strategies, and just a lack of understanding around the liquidity tied to the flex options market. And flex options actually started trading in this country back in 1993. Many billions of dollars trade hands daily. It's actually an extremely liquid market. But when you launch a new ETF, there's obviously initial concern, or not necessarily concern, but skepticism around, if I see a bid-ask spread of 4 cents wide, is that going to hold? Is the offer at $26.94 correct, or should I potentially place an order at 93, and am I going to get filled there? Or because it's so brand new, am I going to move the market up 5 cents if I buy it? Any new ETF, and especially any new ETF that leverages flex options, for example, the big misconception is that you're going to get an unfortunate fill if you're looking to buy on the offer. And that's just not the case because of the liquidity and the massive amount of liquidity behind both the ETF as long as the underlying, or say the S&P, and then marrying that up with flex options. It's actually an extremely liquid market, and we've seen a lot of flows into these over the years, the last couple of years, and a lot of the fills, in my experience, and part of that has been on the capital market side, is seeing fills not only at the offer, on the offer, but sometimes maybe a penny or two inside, depending on the notional amount you're looking to do. And in fact, it's unlike a stock. The more you're looking to do, the higher is the probability that you might actually get filled a penny inside the offer, depending on the ETF.
Great. Andrew, anything to add?
Yeah, I would say that on top of that, so flex options have got very liquid, and they've been trading for a long time. But as the market makers become more comfortable with them, the liquidity grows, and even during adverse market conditions, the pricing of flex options is held up, I think, very well. I mean, the caps, if the market goes in a long downward trend, the caps tend to rise, but they're always very much in line, and they're checked against the listed options, right? So even though we can't necessarily look at a lit screen, we do have option models that we're able to tap into and find out that looking backwards, the pricing holds up quite well in all market conditions.
And if you go back to April, PGIM oversees about 22 billion of ETFs. Everything was fine, but if I looked at the most well-behaved portion of our offerings, it was actually the defined outcome ETFs, in terms of premium discounts and spreads and trading. So I do think in that April volatility passed the test really well.
I'll add one more thing too. In a way, as we've seen the derivative market latch on to the ETF wrapper, if you recall about 10 years ago, there was the whole sort of debate for a summer or two around more and more of these fixed income ETFs were coming to market, and actively managed fixed income ETFs. What is that going to do for the bond market, a market that trades over the counter, and sometimes bonds don't trade for months, with now an ETF that you have to price daily and update pricing every 15 minutes, essentially, right? Or actually sooner than that. But in the end, we found that really it was a good thing, right? We went through 2020, went through COVID, we had a major market dislocation, and bond products overall, some spreads widened, but in the end, held up really well from a bid-ask spread standpoint. We went through that again in 2022. More products, more bond products, more trading, which forces transparency in a market that trades over the counter, was good for it. And now, in a way, we're kind of going through something similar with derivative-based ETFs. And I think the more players come to market, the more liquidity, the more volume, the more assets, it's only a good thing for it in terms of long-term spreads being ideally as tight as possible.
I think that segues nicely into discussing how, over the past 6 years, how these have performed during periods of volatility, whether it's the initial COVID sell-off back in 2020, 2022, and what insights that can offer about the role of these products in a market like we're experiencing today, where we've had the market go up and up for much of the year, and then we've seen a pretty significant sell-off over the past few days.
Yeah, but I can start with that. So I think you think back to COVID and you think back to 2022 and what happened. I think it speaks very highly of the benefit of a defined outcome strategy within a portfolio. Let's say it's a 365-day outcome period. And if you had that through COVID, how happy are you going to be if you owned it at the time that if I just hold this for the rest of the outcome period, I know exactly what my downside is going to look like. COVID was a very quick snapback, but it was pretty scary in the middle of March, third week of March, when the market was cratering. We thought that could have gone on for a lot longer than it did, right? So had you been in a buffer strategy at the time, a defined outcome strategy, and you knew exactly what your downside was going to look like, and remember, the options contracts backed by the Options Clearing Corporation, that's a Dodd-Frank too big to fail entity. So those contracts are going to hold up when you get to the end of the outcome period. So I think market events like that speak to the value, the many different types of value associated with adding a buffered solution to your equity sleeve or even to your fixed income sleeve if the cap rate and the downside makes sense in terms of how you're constructing portfolios.
So if you go back to 1993 and look at S&P returns on a monthly basis, the S&P is positive 78% of the time. The problem is when you have these drawbacks in COVID, I don't think any client of yours would say COVID was a great year, but actually from a calendar year basis, it was pretty good. But when do they call you? They call you when things are negative, and the simple question is, how did we get here, and how do you get out of it? You may be locked up in an investment where you have absolutely no clue how you get out of it. And you have to have that conversation back with the client and hope that that's part of your portfolio recovers and keeps up with the S&P, but that's no guarantee. With these defined outcome ETFs, it's a way of navigating those conversations because you know exactly how much time is left in the outcome period and how you recover. Now, I will say, if you map the one period of time where these buffer defined outcome products don't work, it's at the bottom, right? When the market's down, say 40, 50%, and you have a 50 to 80% correction on the way back, these products will absolutely never keep up, but that's a point in time, right? And with these products, there's always going to be a place for compounding long-only investments, but the ability to say this is exactly how we're getting out of this rut is the power of the defined outcome product.
Andrew, anything on your end? No. Okay, perfect. Okay, let's look ahead to 2026 and beyond. It's hard to believe it's the end of the year. But what innovations do you see shaping the next generation of defined/buffered outcome ETFs or options-based ETFs more broadly? Maybe, Andrew, we'll start with you and make our way down.
Yeah, so as time goes on, it's just adding complexity, right? So, there's probably departments full of product creators who are having the time of their lives, coming up with different things they can do with flex options. And to their point, having flex options backed by the OCC gives them a lot of leeway to, kind of create and ensure that they're able to deliver the outcomes that they're promising in their prospectus. But so what I see is just different ways to, recreate structured products and bring them to retail investors, and increasing the amount of complexity and the different flavors so that they can, create new portfolio management techniques. That's kind of what we're seeing, develop in that space.
Yeah, so You saw it in 2008 with one of the first ever actively managed bond ETFs come to market, which was a Bear Stearns ETF, YYY. That was sort of 15 years after the launch of SPY. And then in the 2010s, you saw multi-factor equity ETFs come to market. You then, along the same lines, you started to see covered call ETFs, and you really saw covered call ETFs explode around 2020. The next phase you're starting to see happen right now. So you're starting to see, so there's the structured note market. It's a very complicated market. If you want to go buy an auto-callable yield note for a client, for example, the client has to fill out paperwork. You've got to go bank shopping, and then they're bespoke, right? So you can customize it however you want. You can buy a structured note. You can now buy that in ETF format with better tax advantages. So for instance, if a structured note typically pays 12%, you can now access that in an ETF wrapper on swap, and the vast majority of that income is going to be return of capital. So if you hold the ETF for at least a year, that's all converted into long-term capital gains. So you're going to see, you see it on file, and you're going to see a lot more come out, but you're going to see structured note ETFs hit the market, and a lot of them auto-callable, because auto-callable is 70% of the structured note ETF market. So in 2026 and 2027, you're going to start to see that really dominate. Headline yield is a huge thing. You're going to see some of these 13, 14, 15, 16, maybe 17% yields. Make sure to do the due diligence, look underneath the hood, see how it is structured, to get a sense of price appreciation, because the price chart never lies. If you want to learn about a covered call ETF's percentage that is covered versus uncovered, for example, or a structured note ETF that's out or coming to market, and there is any sort of price history, check it out relative to the underlier at which it's pegged to. Because if it's flat and the S&P's up, that means it's maximizing its income and giving up upside. It's basically converting future price performance in the form of present day cash flow. If it's paying out a little bit but giving you upside, it's because it's just not covering as much. So know the coverage ratio with these solutions that come to market.
Yeah, so PGIM's trying to find what I would say is the middle ground in this space. There's only a handful of firms that actually have offerings that are complete, right? So they have ETFs that have a fresh cycle every month, right? On January 1st, you have multiple products that have new outcomes. You have to have that to have a defined outcome. You can't just launch 3 ETFs, call them a defined outcome, because that's not how the portfolio construction process works. You have cash flow needs throughout the year, right? So there's only a handful. So we have 40 plus defined outcome ETFs primarily to fit that need. But I think where we're struggling and where this industry is going is you still have to have some sort of investment thesis, right? Clients, whether it's financial advisors, REAs, or actual clients, just guess at risk. It's just this random sort of number that means 1,000 different things to each individual. Risk needs to be grounded in reality. Because if you buy too much risk, you are going to miss what you actually need out of the equity market. So we're trying to stay grounded in buffer levels and defined outcomes that actually represent what basic indices have done historically. But I will say that when you have clients that are coming from the structured note world, they're used to you just offering whatever thought or need they have from the structured note world and launch an ETF. And there's going to be hundreds of products that fill that need. So we're trying to, I think, play the middle ground. The other thing that I'll mention, about half of the defined outcome flows are starting to go to what's referred to as ladder ETFs. These ladder ETFs, are what they're trying to do is take out the timing risks that exist in defined outcome. So rather than having to buy on January 1st or February 1st, you can buy a ladder ETF that's buying each month equally. If you throw a dart at the board on any of these products relative to the ladder on any date, the ladder ETF actually gives you the exact same thing because it's owning the defined outcome. So as we talked about it, the defined outcome is good for solutions and needs of your clients. The ladder product is meant for portfolio construction. And you're seeing a lot of the providers out there come to market with these ladder products. Part of it is because it's easier to launch that than to launch 40 defined buffer ETFs, in a whole circle. But the ladder ETFs are solving that portfolio construction need to give you a defined outcome like experience, but much more easy to access.
Anyone have anything else to add on the latter products? I think those are interesting.
You know, I'll just quickly add. You know, it's a good point. So the ladders, you know, what we've seen clients, how we've seen clients view them is more sort of model-ready solutions. You know, to Matt's point, if you're going to go buy, or you want to buy a, you know, single point-to-point buffer ETF, you're going to have to keep an eye on it. You might have to move assets to something else to a different month if you don't like the setup a year later, or you can just buy a laddered version of, say, 12 monthly S&P 500 capital protect ETFs, stick it in your model. You take the timing out of the equation. The cap rate's going to evolve over time, and there's as well as the capital risk component. But it's essentially a much easier, much more time-efficient way of getting exposure to call it a series of buffer ETFs.
And we had mentioned earlier that the vast majority of buffered and defined outcome products on the market are based on the S&P 500. I'd love your views on other either indices or asset classes where we're seeing this buffered outcome strategy evolve into, where it works, where it doesn't work. Thoughts on that front?
I mean, I'll give maybe just a 30-second answer. Right? What we're trying to solve in future product development are what are the asset classes where vol overwhelms your experience. And emerging markets is one there. Small caps tend to come and go, but if you can take X amount of vol out of those traditional asset classes, you can actually have a much more improved Sharpe ratio experience in those asset classes. And even if you look at EFA and emerging markets, there's just been so much vol, particularly even from currency, that makes it a less attractive investment. So that's one area that we're considering to make it a little bit more attractive. But at least for us, it would still be on the basic indices that clients know and use.
Yeah, we're seeing it with Bitcoin, for example. So we launched a sleeve of Bitcoin buffer ETFs earlier this year, and the big thing we wanted to solve there was if you look at Bitcoin standard deviation over the last 3 years, it's like 75%. It's like 5x, about 5x the S&P 500 standard deviation. So if you can bring that down and match the risk personality to an everyday index that you have throughout portfolios, now you're going to have, you know, upside to a cap, right? So if you're going to do that in options world, to get something like that, you're going to have to give something up. You're giving up all of Bitcoin's upside. But depending on which one you own, you might have 30, 40, potentially 50% cap rate over the course of the year. So yeah, you're going to see that, I think, continued on with assets like Bitcoin, where you have these large, enormous standard deviation profiles. So a way to rein that in, maybe make it equity-like, NASDAQ-like, however you want to classify it, and then you have a good, healthy chunk of upside, but to a specific point, right? But now you know what your downside looks like on a go-forward basis.
And I guess, you know, just we don't have a Bitcoin. You know, there's a number of them out there, but go back to what we mentioned earlier in buying the outcome. Vol gives you more upside, right? So you're not necessarily changing your investment from S&P to Bitcoin to NASDAQ because of what that index is going to offer. You're doing it because they have higher vol and you have a potential much more attractive upside, and you're buying a buffer that makes sense for that asset class. So that's going to be, I think, one driver of growth in the industry as well.
Taking it all the way down to the operational level, from what my firm has seen, broad-based indexes do really well in buffered products. You still need a good amount of liquidity in whatever it is you're trying to trade in order to make a buffered product out of it, with flex options especially, because of the effort that goes into doing the trades and doing the daily creations or redemptions. So spiders, Qs, IWM, those are all very liquid, and you can make products off of those. There's been some interest in trying some of the less traded indices over time, and they just don't take off as well from the market making community because it becomes hard to get the assets from more than one or two interested market maker counterparties. It really behooves everybody if there's a big liquidity pool involved in making markets on this stuff, because not everybody's going to be available every day, and just the more pricing you get, the better pricing you get. So I guess taking it all the way down to that level, the broad-based indexes tend to do better than some of the more, esoteric ones.
Sure. We only have a few minutes left, so I'd like to open it up to questions. Feel free to raise your hand if you have a question for the panel. There you go. Oh, he's right here.
Hi. So this is not a direct question about what you guys are talking about, because I think the buffered ETF product is a lot better than what I'm going to ask you about. But one of my clients was sold a buffered product by a money manager affiliated with the insurance company, not PGIM. And it was atrocious. So it was misrepresented. They thought it was a 3-year buffer type thing. It turned out to be 3 years of equity buffer, but then it converts to a 3-year fixed income product with still downside exposure to the S&P after that. And they thought it was 3 years, and they're stuck in this thing for 6 years. So the question is, I don't know if you guys know the answer, but being in the industry, maybe you do. What kind of fees are being paid to these insurance agents to sell this stuff?
Well, Prudential is my employer, but I'll answer it regardless. Annuities have incentives for the advisor and the salesperson. That is one large driver of interest in the space. But also, we advertise our caps and we advertise our expense ratio. No, but on the annuity side, one driver of profit is a reduction in that absolute return back to the client, right? So you may not see an actual fee, but if you buy an ETF that has 16% upside, the annuity may actually give you 14% upside, and there's a spread capture for potentially the annuity side. But to your point, unless you're sitting there reading through the contract, clients don't understand that easily. Now, it's up to the financial advisor to certainly explain it, but that is what we were trying to solve, is give liquidity and give, more importantly, transparency to the outcome that we're trying to solve relative to structured products or other vehicles. Does that?
Yeah, kind of. Any idea what the fees are? I'm just curious.
The incentives are north of 1%. North of 1%. Mm-hmm.
North of 5%?
No. I mean, not for a reputable insurance company, but yeah.
We probably have time for one, maybe two more quick questions.
All right, thank you guys. My name is Jay Wei. I'm a financial advisor from Merrill Lynch. And my question is, because we've been using a little bit of structured notes, and what we typically do is we put client into the structured notes in the starting point, and then we know exactly what we're going to get based on the outcome schedule of that structured notes. But then in terms of the ETF, since it's trading in the market, the client can totally get into that at the premium. And then even though that, say, the market may be down less than the buffer at the end of the day, but then they may still suffer loss because they're buying from the premium and the price of the ETF goes down. So I just want to see how the products solve that issue.
Yeah, I can speak to that. So you're right. If you buy a single structured note, let's say you buy an auto-callable note. Let's say it's a 5-year term note, 1-year non-call period. If that note's called away, you know you're getting back par on it. If it makes it the whole 5 years, you know you're getting back par on it. That's what you're giving up if you were to buy a laddered, 5-year term, perpetual ladder, auto-callable yield note ETF. The net asset value is going to trade in conjunction with that weighted average bond price. So if one day the net asset value is $25 a share, and the weighted average bond price is right at par, there's no maturity date, obviously. So when you sell that, if the market drops, you could be selling it and taking a loss. That's what you're giving up. What you're getting is better tax treatment. You buy a structured note, that's ordinary income on the interest that's paid out. You're also getting diversification. You own one note, versus a laddered portfolio of 50 to 100, let's say, for example. So there's no perfect strategy out there. If you say, I'm going to start buying auto-callable yield note ETFs going forward that are laddered, there are pros that you're going to pick up relative to buying a single note. Just like if you buy a single note, you know exactly what that price is going to look like at the end, but you're losing favorable tax treatment relative to the ETF. You're losing diversification. And also with auto-callables, when an auto-callable yield note is called away, it can be hours, sometimes many days of paperwork to get back par on it, fill out the paperwork, go bank shopping again for a new note. The ETF is just a single easy button where you set it and forget it. And every, say, Friday, for example, a new 5-year term note is added, and you don't have to go through the arduous process of when something is auto-called.
I'll just give a 10-second addition to that. So we update our website every 15 minutes with the market price of the ETF, and we translate, thanks to ETF Global, translate that to how much buffer and cap is left if you bought at that price. So they can see that, oh, it was 16% cap, but actually it's 14 given the market price. That's how we manage it and give that information back to the client.
Great. That's all the time we have for this session. Thank you very much to our panelists.
Thank you.